Today, we're not buying a new stock. That's on purpose. Sometimes the best move in the market is no move at all. So let's review our portfolio and see how we're doing. Hey, it's Chris with Dividend Stock Scout. Quick update before we dive in. This week, my dividend screen only was spitting out retail names. At the same time, we've already got a jumpy market, the Fed sending mixed signals on future rate cuts, and stock valuations sitting near the high end of their historical range. That combo screams be careful and not to load up on more retail. So instead of forcing a trade just to say we bought something, we're going to do a portfolio check in and talk about why we're staying patient this week. And as always, this is not financial advice. This is for education and entertainment only, and you should do your own research before investing. Let's get started. Okay, so big picture right now. The S&P 500 had a huge run earlier this year, up around double digits, but November has been choppy with the index giving back some of its gains. We've got a lot higher volatility, and a lot of that move is driven by a small group of big tech names, which makes the market more fragile than I think it looks. The Fed did cut rates a bit recently, but they're now hinting that more cuts may be delayed. They're just, kind of waiting. Powell is one of those let's wait and see type of guys. So we're still in an environment where money isn't free and valuations actually do matter. Now, retail. Consumer spending is still positive. Retail sales are up year over year. Holiday sales are expected to pass $1 trillion for the first time, but growth is slower and less predictable. So consumers are still spending, which is awesome. But the margin for error for retail companies is getting a little bit thinner. And I don't want our portfolio to turn into a cluster of retail names at exactly the wrong time. That's why we're standing down on any new buys this week. So now let's walk through the portfolio and see how our current positions are doing. Okay, so right now, the Dividend Stock Scout portfolio holds four positions: Aflac, Lowe's, Qualcomm, and Williams-Sonoma. We're early in this journey, so position sizes are small by design. Remember, I started this with the $1,000 bankroll. These are expensive stocks, and I'm adding $400 a month, trying to target around a 12% annual return over the long run. We're also protecting our investments using a 20% trailing stop on each stock. And that's based upon the highest price since we bought it. So if a stock falls 20% below that high, we take the loss and we're going to move on. So let's break these down by name. So first up, we have Aflac. Aflac is a big insurance company known for supplemental insurance and a huge business in Japan as well as the United States. The stock currently sits at about 114s or so. We bought it at around 107. It's now trading in the mid 110s. So we're sitting on a small unrealized gain of roughly about 6%. So our trailing stop now has moved up and is 20% below that high, which is down into the low 90s. Its dividend yield is around 2%. Aflac has actually raised its dividend for over 40 straight years, which is a big plus for dividend investors. The current P/E ratio is in the mid-teens, a little above its long-term average, but not too crazy. So Aflac is not a super high yield play, but it's a steady dividend grower with a long track record. And I'm comfortable in holding this. Insurance tends to be a lot less cyclical than retail. So if the economy slows, people may skip a new couch, but they don't usually drop their insurance coverage first. Aflac throws off solid cash flow, and management has a long history of returning cash to shareholders through dividends and buybacks. So for now, Aflac stays in our portfolio. We'll keep letting the dividend and the trend do the work with that trailing 20% stop loss as our exit plan if things happen to break down. Now let's jump into Lowe's. So Lowe's, as everybody knows, is a home improvement retailer. They sell the stuff you buy when you want to fix, upgrade, or remodel your home. And currently, we bought Lowe's around 244 per share. It's now trading in the low 230s, so we're down maybe 4 to 5% on paper. Since we bought it, it has traded at as high as about 246. So that's our highest since buy price. And the trailing stop sits around 20% below that. Its dividend yield is roughly 2%. It has a free cash flow for 2025, and it's strong and it's growing, which is something I always look for in a stock. The PE ratio is around 19 times earnings, a bit richer than its history, but again, it's not insane. So you're paying for a fair price for a high quality cash generating business. And this is why I'm okay in holding it, but not adding more to it in retail, because it is technically retail, but it's tied to housing, repairs, and DIY, which behave a bit differently than clothing or pure discretionary spending type of retails. With rates, it's still not cheap. I don't want to load up on more consumer names while the Fed is hinting at slower cuts and the market is already a bit stretched on valuations. So the plan here is to continue to hold lows, watch the trend, let the dividend and buybacks work in the background, and let that 20% trailing stop be our line in the sand. And let's not forget, coming this week, they are actually going to report earnings, so something we definitely want to keep an eye on. Now we have Qualcomm. So Qualcomm makes chips and technology that power smartphones, wireless networks, and increasingly more so in cars, connected devices like Internet of Things. And they're trying to dive into this AI play that's happening right now. So really, it's a play on 5G, AI at the edge currently, and mobile computing. So currently, actually, I'm sorry, we bought the stock around 180, 150. And right now it's trading in the high 160s to low 170s. So we're down around 5 to 6% on the position, which is kind of a bummer. Since our buy, the stock ran up into the low 180s with a recent high around 183. That's our highest since buy price. And the 20% trailing stops well below current prices, giving the stock some room to move. Now, its dividend yield is around 2% with an annual payout of about $3.50 a share. It has a free cash flow that is strong and it's growing. The PE, though, has pushed into the mid 30s on its trailing earnings after a big run this year, which is on the expensive side versus its own history. So Qualcomm's a great business, but the market is already pricing in a lot of its growth. A lot of why we like the stock has been baked into that price already. So check out my other episode where when we picked it. So this is the one play I'm watching really closely and we have to be careful with because a correction in the market is probably going to hit this one stock the hardest out of all of our stocks because so much is already baked into the price. Now I'm still holding it and my take is simple. The AI and connectivity trends are real, cash flow is strong, and the dividend is solid and growing. But I don't want to chase this any higher or average up while the PE is stretched. So for now, we hold, let the position either grow into its valuation or let the trailing stop take us out of it if the story cracks. All right, last one on our list is Williams-Sonoma. That was the one we did last week. So Williams-Sonoma is a premium home goods and kitchen retailer. Think cookware, furniture, decor aimed at affluent customers. So really more high end. We got into Williams-Sonoma at exactly 197. Right now, the stock is trading close to 183. So we're roughly down 7.5% in 1 week from the time of purchase. This is a perfect example of why retail stocks make me cautious because the fundamentals look good, but going into this holiday season, we're kind of all over the map here. The entry price is still the highest price since buy for now, so that puts our trailing stop at $157 and change. Now, dividend yield is around 1.3 to 1.4%, so a lower yield than our others, but it has solid growth. The P&E ratio is in the low 20s, above its long-term average, and the price to free cash flow ratio is also elevated versus recent years. So the market already expects decent growth and strong margins from Williams-Sonoma, probably for this retail season, and that's why I'm not adding any more into retail now. And honestly, when it comes to the retail stuff, this is where your personal comfort really matters. We already have one premium retail name in the portfolio. The screen is now serving up more retail at a time when the economy is fine but not booming. Consumers are still spending, but growth is slowing a little bit, and valuations across the market are on the high side. So instead of stacking up more exposure into the same sector, I'd rather hold what we've got, see how Williams-Sonoma trades into the holiday season, and just really let our 20% trailing stop protect our downside. All right, so here's the big picture. The screen is doing its job. It's pumping out things for me based upon the rules that I've set that look good. It's finding names that fit the rules, basically. But right now, everything passing the filter is primarily retail, And just because something's passing the screen doesn't mean that we're forced to buy it. You still get to say, you know what? I'm not comfortable loading into more retail in this kind of economic evaluation environment. It's not being scared. That's called risk management. So we already have exposure to insurance with Aflac, home improvement with Lowe's, semiconductors and wireless with Qualcomm, and premium home retail with Williams-Sonoma. So the job this week is just to manage what we own, not to force a new pick, just to stay busy. So our plans for the coming week. We're going to continue to hold all four positions. We are going to keep the 20% trailing stops updated based upon our highest buy price or price since buy in the tracker. We're going to let our dividends continue to drip in over time. And we're going to run the screen again next week and see if we can find a candidate that's outside this crowded retail space. If the market gives us a high quality, fairly valued dividend player in a different sector, we're going to be ready. And if it doesn't, we're also just fine sitting in our hands and protecting our capital. So again, thanks for hanging out with me for this portfolio check-in. If you like this slow, rules-based approach to building dividend portfolio with clear risk rules, hit like and subscribe down below. Drop a comment on how you're handling this volatility, and let's just chat. And again, this channel is for education and entertainment purposes only. This is not financial advice, and I'm not telling you what to buy or sell. I'm just showing you what I'm doing with my own small portfolio and how I think through risk, return, and valuations. And in some cases, when doing nothing is actually the smart move. Until next week, thanks everybody for watching. Take care.